Hey everyone, welcome back to Corporate Decoder, the place where we pull back the curtain on the numbers that shape our world. And today we're diving into GreenTech Innovations Incorporated's latest look under the hood. If you thought things were quiet, well, this report might just surprise you with what is going on behind the scenes. Before we dive in, if you love getting these clear, no-nonsense breakdowns of complex corporate documents, be sure to subscribe and hit that notification bell. Also, we have a thriving community over on Discord, link in the description so you don't miss out on those deeper discussions. Alright, so what we're looking at here is a Form 10Q, which is essentially a quarterly report. Think of it like a regular check up for a company, telling investors how they've been doing over the last 3 months. This particular report covers the period ending the 31st of August 2025. Now, usually these reports have a lot of legalese, but we're going to cut through that and get to the heart of what matters. Let S start with the balance sheet, which shows you what a company owns and what it owes at a specific point in time. As of the 31st of August 2025, and looking back to May 31, 2025, you'll notice something striking right away. The total assets line is blank, showing 0. That's a big deal. When a company has 0 total assets, it essentially means it owns nothing significant. This often points to a company in its very early stages, or one that might be facing significant financial distress. Now, look at the other side, liabilities and stockholders' deficit. For the 31st of August 2025, total liabilities are listed at a little over $452,000, and the total stockholders' deficit is also a negative $452,000. This means the company owes more than it owns, resulting in a deficit. It is like owing more on your mortgage than your house is worth, but on a much larger scale for the entire company. Here, it tells us about their common stock. They have authorized 75 million shares with a very low par value of $0.01. What is interesting is that as of the 31st of August 2025, they only had 606,475 shares actually issued and outstanding. This is a tiny fraction of what they could issue. This number, 606,475, doesn't seem to have changed much between May and August of 2025. It is a small number of shares in play for a company looking to make a big splash. Next up, let's look at how the company performed in terms of making money, or in this case, losing money. This is the statement of operations. This table compares the 3 months ending the 31st of August 2025 with the same period in 2024. In the 3 months ending the 31st of August 2025, total operating expenses were about $11,149. That is down significantly from $17,538 in the same period last year. This 36% drop in operating expenses might sound good, but remember, it is coming from a very small base. And what was the bottom line? A net loss of $18,597 for the 3 months ending August 2025. That is better than the $24,986 net loss from the previous year. So they are losing less money, which is a positive step, but a loss is still a loss. The net loss per S hair is showing a loss of $0.03 for the period ending the 31st of August 2025, compared to a loss of $0.04 in the prior year. This shows a slight improvement on a per share basis as well. This statement details changes in the stockholders' equity. It reinforces the narrative we're seeing. As of the 31st of August 2025, the total stockholders' deficit stands at a negative $452,960. This is an increase in the deficit compared to May 31, 2025, which was around a negative $434,363. This means their losses are accumulating and the deficit is growing. Now, looking at the prior year, the deficit was even larger at a negative $398,699. So, while the deficit is growing, it is growing from a larger deficit last year to a smaller one relative to the overall financial picture, but the trend in the deficit is still a negative one due to the net losses. Let's move on to cash flow. This shows you where the company's cash came from and where it went. For the 3 months ending the 31st of August 2025, the company used $12,350 in cash for its operating activities. This is an improvement from the $16,631 used in the same period last year. This directly reflects the smaller net loss we just saw. When a company loses less money, it uses less cash in its operations. Where did the cash come from then to cover these operating expenses from financing activities? Specifically, an advancement from a director of $12,350 for the 3 months ending the 31st of August 2025. This is a recurring theme, essentially. The company is being funded by its director to stay afloat. The net cash provided by financing activities was $12,350 for the period ending August 2025, exactly matching the cash used in operations. This indicates that the company is not generating its own cash from its business activities and is relying entirely on financing. In this case, from a director. Diving into the notes, we get more context. This section talks about the company's history, its initial business idea of a cellular rate plan app, and how it has evolved. We learn about name changes and stock splits. Most recently, on the 25th of April 2025, they changed their name to GreenTech Innovations, incorporated and did a significant reverse stock split, which effectively reduces the number of outstanding shares. This is often done to increase the stock price, making it appear more substantial or to meet listing requirements. Their current business focus is on developing travel meta-search engines and operating international online travel portals. This is a significant shift from their original app idea. This is a critical section. The going concern note is where management addresses whether the company can continue to operate in the foreseeable future. This is a stark statement. The company has accumulated total net losses of nearly $40 million since its inception in 2013. They also have negative working capital, meaning their short-term debts are more than their short-term assets. Essentially, they do not have enough liquid assets to cover their immediate obligations. Management explicitly states that the company's ability to continue operating depends on successfully implementing its business plan and becoming profitable. This is the classic statement of concern for the company's survival. They acknowledge they may need more capital and that their failure to get it could be bad for shareholders. This note details their convertible notes. These are essentially loans that can be converted into stock. We see a breakdown of these notes issued at various points, starting in June 2019. For example, the convertible notes from June 2019 were around $56,859, and similarly for other dates throughout 2019 and 2020. Interestingly, the notes issued in June 2019 carried a hefty 25% interest rate. That is extremely high and suggests a very risky loan. They also had conversion terms at a very low price of 1 cent. Per S-Hair, they were also due on demand, meaning the lenders could ask for their money back at any time. We're now in the management's discussion and analysis section, where the company's leadership talks about their performance and outlook. The forward-looking statement section is standard legal boilerplate, warning that predictions about the future might not come true. This section reiterates the company's history and business evolution, similar to what we saw in the notes. This confirms their current focus on developing travel meta-search engines and online travel portals. Here we look at the financial results again, comparing the 3 months ending the 31st of August 2025 to the same period in 2024. The net loss has decreased from $24,986 in 2024 to $18,597 in 2025. As management notes, this is mainly due to a decrease in professional fees. Reducing professional fees can be a sign of cost cutting, but it can also mean less investment in important areas like legal or accounting advice. This section discusses liquidity, essentially how much cash the company has to meet its short-term obligations. The working capital deficiency has increased to $452,960 by August 2025, up from $434,363 in May 2025. This increase is attributed to rising amounts due to related parties and accrued interest. So their short-term financial picture is actually getting worse despite the smaller net loss. We already touched on this with the cash flow statement. The company continues to use cash from its operations, and this is covered by financings. The $12,350 received from the Director S advancement in the 3 months ending August 2025 is again highlighted. This underscores the reliance on this director for funding. They state they have no off-balance sheet arrangements that are likely to affect their financial condition. This means there are no hidden debts or obligations that aren't already reflected in the financial statements. This note to management's discussion is crucial. They again reiterate the going concern warning, highlighting the accumulated losses and negative working capital. They explicitly state their financial statements do not include any adjustments for the uncertainty of their ability to continue as a going concern. This means they are operating under the assumption they will continue, but they are acknowledging this is a massive question mark. As a smaller reporting company, they are not required to provide detailed disclosures about market risks like interest rate fluctuations or currency exchange risks. This is common for smaller businesses that likely do not engage in complex international transactions or take on significant market exposure. Here is a really important point: management, including the CEO, has concluded that their disclosure controls and procedures were not effective as of the end of the period. This means they are not confident that all the important financial information required by the SEC is being properly recorded, processed, summarized, and reported within the necessary timeframes. This is a significant red flag regarding transparency and accuracy in financial reporting. However, they state there were no changes in their internal controls during this period. This implies the lack of effectiveness has been an ongoing issue, and no material improvements were made. They state they are not aware of any material legal proceedings against the company, nor are they involved as a plaintiff. This is good news, as litigation can be incredibly costly and damaging. Again, as a smaller reporting company, they do not have to detail specific risk factors. However, the going concern note in the financial statements and MDOA section implicitly covers the biggest risk: the survival of the business itself. This section lists all the documents attached as exhibits to the filing. Most are standard corporate documents like articles of incorporation and bylaws, or certifications required by the SEC. Finally, the signature block. This is where the principal officers of the company, in this case Kevin So, President, Chief Executive Officer, Secretary, and Director, sign to confirm the accuracy of the report. Kevin So is listed as the Principal Executive Financial and Accounting Officer. So, what is the story here for GreenTech Innovations Incorporated on the surface? They are showing a reduction in their net loss and a slight improvement in net loss. Per S-Hare, they are also shifting their business focus to online travel aggregators. However, beneath these superficial numbers lies a much more concerning reality. The company has accumulated nearly $40 million in losses since its founding, possesses zero significant assets, and has a growing working capital deficiency. Their operations are entirely funded by advancements from a director, indicating a complete lack of self-sustaining revenue. This reliance on external funding, particularly from a director, coupled with the admission that their disclosure controls are not effective, paints a picture of a company struggling to maintain viability. The high interest rates on some of their past convertible notes also speak to the desperation for capital they may have faced. The fact that they are still operating, despite these dire financial indicators, hinges entirely on the continued support of their director and their ability to secure further financing, which the report itself states is uncertain. The substantial accumulated deficit and the effective absence of tangible assets raise serious questions about their long-term prospects and their ability to ever become a profitable enterprise. My assessment is that this company is in a precarious financial position, facing significant going concern risk. The consistent trend of losses and reliance on director advancements are major weaknesses. The opportunities lie solely in their ability to pivot their new business model into something that can generate substantial revenue very quickly and in securing external investment without prohibitive terms. The primary risk is the continued inability to generate revenue and the potential cessation of operations if funding dries up. Alright, that is our deep dive into GreenTech Innovations Incorporated's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and make sure you subscribe for more deconstructions of corporate filings, and don't forget to join the conversation on our Discord community, linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.